Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the executive orders and memos put out by President Trump on Inauguration Day that relate to housing and what we should expect next. Logan, welcome back to the podcast on a pretty momentous day.
Yeah, inauguration aftermath. So we're up last night dealing with a bunch of stuff, and we're recording this on Tuesday morning. So, by the end of the day, things might change, but definitely kept us up.
It did. So we had this flurry of activity on Inauguration Day. And if you'll remember last week when we were talking, I was like, day one. And I was thinking day one was really Tuesday, today, not Inauguration Day. Generally speaking, Inauguration Day is parties and balls and all that kind of stuff. Nope, not last night. He sat down and started signing executive orders. I think his goal was to do 100 of them. So we were busy parsing through that, going, okay, which part of this is going to impact housing? He had more than 10 executive orders on border security and immigration things. He had DEI. He had energy and climate change. He had, renaming the Gulf of Mexico. But a couple of things that really impacted housing were inflation and then tariffs. And I would love for you to talk first about the tariffs because, you saw some action afterwards in the bond market. So on tariffs, what did he say and what was the result?
So let's go back to Jobs Friday, right? Labor over inflation. The Jobs Friday beat estimates. Bond market went vertical. 10-year yield got up. 10-year yield was 10 basis points above my peak forecast for 2025. Then the CPI inflation data came out. The core part of that, even though the headline month to month was hotter, which would have sent the 10-year yield rising before, the core came a little bit less. 10-year yield waterfall dive. Then here we are going into the inauguration. The 10-year yield's at 4.63%. As soon as the term committee is created for tariffs, certain bond traders went ahead, bought the 10-year yield. 10-year yield fell, I think, as low as 10 basis points overnight trading. So you always got to remember, some people don't have the ability to look at overnight trading and they're confused. The 10-year yield had that waterfall dive off of that. As of this morning, we're talking it's 4.57. By the end of the day, it could be different, but for the most part, it helps some of the gains. Mortgage pricing, nothing crazy, but for a lot of people, just a little bit better on pricing. I know the spreads are a little bit worse today, but what it's done is now the 10-year yield's gone from 4.81 to as low of overnight trading at 4.53. And to me, it was just fidgety bond market people at key technical levels, and you see these waterfall moves and vertical moves off of headlines, and that's just how they're just operating. And when the 10-year yield was at 4 or 380, and we had that conversation where you asked me about what about more rate cuts, I said, Sarah, so much is already priced in right now that you really need much weaker economic data to warrant the 10-year yield to be at this levels. And 10-year yield shot up. The economic data got better. We're growing at 3% in Q4. Consumption data is fine. Jobless claims are low. Here, I just think that when you get above 470, you really need to have like stronger economic data or inflation really to warrant more selling of the 10-year yield at this point. And we have a lot of bond auctions coming up too. So we're just at a elevated level. And when people just saw committee instead of universal tariffs priced on everyone, and we've talked about this, he's going to say a lot of things. He's going to do a lot of things different. It's all part of the strategy. And that's all that happened. Bond traders just took the headline and went with it.
Right. So he had an executive order where he ordered a committee to look at tariffs. But then, at some point during the night, a reporter asked him a question about tariffs, and he said that he was planning to enact 25% tariffs on Canada and Mexico starting on February 1st. But that didn't get put down in writing last night. So what everyone decided to act on was what actually got put in writing.
As soon as bond traders saw committee, they just went with that. That's kind of all it is. And you got to remember that one tactical thing the president could do is enact the tariffs against China, Mexico, and Canada and just try to squeeze them into like getting a deal done. This is just how he operates. So what bond traders just went with was the committee line. And for those of you that are listening to their bond traders, you know what happened. They just went with it because, again, there's a lot more money in the bond market than stock market. So, you do have a kind of a herd mentality at times, and bonds get oversold and overbought at levels. So just for that, it was just really the committee headline. It wasn't, a lot of people talked about there's going to be, an executive order on 25% tariffs on everyone, and that didn't happen. So we got a little bit of move lower in yields, and for now, that's it. By the time this podcast comes out, something else could pop up and send yields higher or lower. But for today, I'm just trying to explain why did the 10-year yield fall as sharp as it did, and the term committee made that happen.
Okay, so the other big news for housing last night was an executive order that ordered emergency price relief, and housing was one of the things that he wanted that. So he said he orders the heads of all executive departments and agencies to deliver emergency price relief consistent with applicable law to the American people. This will include lower the cost of housing and expand housing supply. Now, this is where it gets interesting. So where do you lower the cost of housing? What at that federal level, what does that look like?
So the theory is that 25% of the cost to build a new home, so this is just the new home market, is regulation. And if we cut regulation, that cost will go away. This doesn't necessarily mean that new home prices are going to fall 25%. This is it kind of reminded me of like when people said, oh, the sellers don't have to pay the buyer's commission. Well, that means home prices are going to fall because they don't have to charge as much. I don't know what world y'all people live in. It does not operate that way. Could you imagine a seller? Oh, honey, let's just lower our price by $50,000 because we don't have this. No. Everyone's going to do as much as they can to make as much money as possible. This is what humans have done since the Peloponnesian War. And since we have documentation of this happening for thousands of years. But in any case, to me, it looks like if you have more wiggle room on your corporate profit side with less regulation, this is I actually equated this to the tax cuts back in 2016. If there's more margins, you can maybe keep more people here. If you have more margins, you have more wiggle room, you could build more. And then if you need to pay down rates like the builders have been doing, I think D.R. Horton is a very good example where they're talking about 4.99 to 5.99 mortgage rates gets things done. If you have more margins to do that with, then you feel better about building more homes. That is a legitimate case. You can make that case out there, and you could maybe free up the capacity to maybe build more just based off of that. But it doesn't necessarily mean, I think some people thought that, oh my God, home prices are going to fall 25% because of, no, that's not how it works. So I think that was one of the reasons why the builders' confidence has picked up the headline number. In the last builders' confidence, the looking out forward fell noticeably, and that was just because mortgage rates were elevated. And we always try to focus on the forward-looking data, especially if rates gone up. When does it turn? It did turn. So in this case, less regulation, less cost. Builders have more margins to work with. You could make that case going out.
And I think the mortgage industry, we saw a lot of lenders and other people online really react very positively to this. They were happy with this news. First of all, they were happy to get an executive order that had anything to do with housing specifically, right? And specifically saying, we need to bring down the cost of housing. And if that's, regulatory, we'll do that. My question to you, though, is that's really just, the only lever there is for new homes, correct?
Yes, that's just the supply of new homes. There's nothing real. There's the only thing you can do to get homes more affordable is get mortgage rates lower. Because then the cost of housing goes down. That's the only thing. There's nothing that's going to change the equilibrium of pricing based on any government action. So mortgage rates go lower would be the only effective thing for existing home prices. And again, like we've seen, when mortgage rates just head down towards 6%, things get better. The builders have shown you how they could keep new home sales elevated to like to the pre-COVID levels by, they do it by paying down rates. Sellers aren't as efficient in selling their homes that way. I wish they were, but builders sell their homes as a commodity. Home sellers sell it to make as much money and move on, and take that money and buy another house. So different spectrums, but the only thing that could, in a very quick amount of time, do anything is lower mortgage rates. Or some people say, well, couldn't Trump effectively tell the government to buy mortgage-backed securities? I don't think that's a good idea about the government doing that. But in any case, he would need Congress to do something like that. So maybe Freddie and Fannie in conservatorship, they wanted to use some of their excess profits. They could use it to buy MBS. That hasn't been discussed, and that's not part of the discussion right now. So just kind of move off the 10-year yield, and everyone be grateful that the spreads have gotten better, because mortgage rates would be near 8% today if we had the worst levels of the spreads in 2023.
Well, and in other executive orders, he did talk about freezing all regulatory, not adding any more regulation until they have a chance to look at it. Of course, he did that in his first term as well. And I think that in general, people would think that's a better business environment. Whether that, ends up lowering the cost of housing, it's a little bit more tangential. But, I do know that there are people who probably think that's a great idea, right? If you're out there running a business, you're like, great, less regulation.
Sarah, I've looked at housing data for the last 14 years, and I'm telling you, whenever the 10-year yield goes down, more people buy homes. When the 10-year goes up, less people buy homes. And I'm going to say the same thing as I told CNBC like 2 years ago. The housing market really revolves around the 10-year yield. The spreads are getting better, like historically they do at this time of the cycle. But as an old high school basketball coach, sometimes you're just putting the ball in the hoop more than the other team is the only reason you won. And in this case, if you're talking about things to get better for people to make more money in housing or sell and buy homes more, it really needs rates to go lower. And that's what we've seen in the data in the last few years. And we see it again. Our weekly contract data for the first time in a while has gone negative year over year. Not by a lot, but noticeable enough, and that trend was getting there every single week. We kept on highlighting, oh, it's getting there. We're only up by 1%, and now we're down by 2%. So keep things simple, and this is why we always talk about the slow dance, right? The slow dance works for a reason. Millions of people buy homes. We had near 5 million total home sales in the last 2 years, 2023 and 2024. We're going to have near 5 million total home sales again this year. But if you're talking about elevating the pool of buyers and making housing cheaper, in that sense, the fastest velocity is rates. And that has the fastest velocity in changing the demand curve.
So, you and I have talked about some of the things that are being discussed and were, had executive orders on. But, just because it's an executive order doesn't mean it happens right away or could happen at all, right? You could have an executive order that gets challenged in the courts, gets tied up in the courts. That happened in the first Trump administration and in other administrations. So we don't know all of that. But from your perspective, you've always said that the tariffs are he's going to wait. If he does tariffs at all, he's going to wait till after he gets his tax plan through. That's his first priority. You still think that?
Well, let's bring it back to our November 7th podcast about, what did Trump do in the first presidency? He talked a lot about tariffs, didn't do a damn thing for the first 2 years, made sure he got his corporate tax cuts in. That was to be a cushion, because everyone kind of knew if you bring in tariffs, corporate profits, stuff like that, people are going to get hit. And what happened was business investment went down to zero, even with the corporate profit, or even with the tax cuts being in, and the stock market was down 20% in late 2018. So I think if you go back to Scott Bessent's testimony, the head of Treasury, and he said, listen, if the Trump tax cuts are not renewed, it's going to be a catastrophe. So we know what their main thing is. They want to get that tax cut in. And then, you have a little bit more wiggle room, maybe. I don't think they want to, for some reason, go into a trade war. Then all of a sudden the tax cuts don't come in as well. Oh, okay. So now you're dealing with stuff So you got to want to set it up in a domino. And again, tactical trade war tap dance. That's kind of what we saw in 2018 and 19. And eventually they signed a deal, got things done. The economy was doing better toward the second half of 2019 before COVID even happened, because if you look at the negative job revisions, we were seeing a lot of negative job revisions to that period of time. And then things were moving on, and then COVID happened. But I encourage, I mean, nobody knows this, but there's a lot of data lines. Manufacturing was getting better, retail sales were better, housing broke out, yields went. Those things were coming in toward the end of 2019, going into 2020. So I'm assuming that they learned some of their lessons, because what Treasury Secretary Mnuchin from Trump's first presidency said, we would like to have a cap at 4.5%. 4.5% 10-year yield, better spreads. Mortgage rates are in the mid sixes, easy. Also, having President Fed Waller last week come out and say, "Hey, everyone, we might cut more." I think there's also recognition. I don't believe all Fed presidents think this, but we've shown those data lines. When the Fed stays restrictive too long, especially in housing, residential construction, lose their jobs. They go into a job loss recession. It happens all the time. You've already lost manufacturing. I think they're a little bit uncomfortable with that last move up higher in mortgage rates, especially what they're seeing. And now they have evidence for it. Builders' confidence data has followed existing home sales. So there is kind of a backdrop about, hey, listen, we can't have yields keep on going up this way, especially after manufacturing had a negative year in 2024.
So I think one of the wild cards that you and I have talked about, you're like, let me see it when it happens. But I do feel like a lot of things were set in motion last night when it comes to immigration. So obviously, when it comes to housing, we look at one of the impacts of immigration, especially if you're talking deportation or just really sealing off the border, is a lot of work that might be done by immigrants, especially construction work, which ties into your recession plans and what it looks like. So 10 executive orders last night on border security and illegal immigration, looking pretty strict on that. So, I mean, it'll just take time, right, to see what does that look like for builders specifically.
I'll always revert back to, if everyone looked at all the deportations in the data lines for 20 to 24 years, the builders somehow find a way to get things done if the 10-year yield goes lower and mortgage rates go lower. So I'm just going to say this. It is like the miracle of miracles. Somehow the builders find workers to get things done when demand picks up. And I talked about this in the last decade. Last decade, everyone's like, we don't have enough people working. As mortgage rates go up, yes. Is demand down? Yes. Oh my God, I'm shocked. Guess what? When the 10-year yield goes down, mortgage demand picks up. Oh my God, you're going to miraculously out of nowhere. It's like the dwarves are coming out of the mountain to help. You are building homes again. So I'm skeptical. This is actually, I wrote an article about this in 2018 about just like looking at the builders' comments, and I said every year they said labor is a problem, and every year when demand picks up, they find people to work. So I've always been skeptical on this. Of course, if you lose a lot of workers and the capacity to do jobs is there, but again, builders are here to make money. They will find people. It might cost them a little bit more. Remember, if you're fighting for labor, you got to provide better wages or better benefits to attract labor. So I'm just skeptical. Call me a skeptic on the labor thing. I need to actually see it in the data where we see builder projects being removed and going, we just don't have people working here, or something like that, and that has scale and duration, and then we could write about it and we can model it out. But I've always been skeptical about this thing.
You have always been skeptical. I keep bringing it up because it feels like it could have a big impact, but we will see. We're on the path now. We'll know soon enough if this is going to have an impact, and then if that has the secondary impact of bringing labor down enough to put us into a recession.
That's not going to do it. It's demand.
Okay.
The
Wait, what do
people
you
that
mean? Like, because you've said that, like, if enough people lose their jobs, then that's the labor trigger for
it
inflation.
is if mortgage rates keep on going higher and eventually all the units that are being completed are done with the permits that can. But I think the notion I was talking about is that all of a sudden we can't build any more homes because we have no one working for us. So that's what I was talking about. Economic cycles kind of all trail the same way. That's why we provide those charts with residential construction workers, like residential and manufacturing construction. Those workers are very key to economic cycle work. So manufacturing is already lost, so we're just focusing on residential.
We are indeed. Okay. Well, do you have anything else to say about the executive orders? Gulf of Mexico, Gulf of America, Mount McKinley, those
No, I don't
things?
care. I
I
just
know you
simply
don't.
don't care. I'm telling you, Sarah. Let me give you my like brutal honesty truth. I've had friends that I've gone to their weddings, whether they be left or right. I don't talk to them anymore. I don't let them text me. I don't let them call me. I don't let them email. I'm just not a political. I understand how all of you people like this is really a personal issue. I just don't care. I'm just here. My job is here to do economic data work. And I just believe when you get into it, like a political ideological, y'all people go in some crazy world. And I just simply devoided myself from that human element. And that's why I just kind of do the things. I mean, when Biden was president, it was like, oh my God, we're going into recession, all these things. And literally the economy outperformed everyone's estimates. And, in 2016, when Trump became president, people say, oh, he's going to destroy him. Nothing. It's just go back in the history of America. Man, we've had some crazy times, man. We've had some
True.
crazy president. We've had things that'll make all of this look like cupcake. Somehow we get through it, So I'm just not that person. And I just like devoid myself. And let me tell you, I am happiest son of a bleep because I look at all of you people, I go, wow, drama, So I just look at numbers. I always
Yep.
said numbers are the closest thing to the handwriting of God for me. And I just work off of that. So if there's things that are changing within the economic cycle, I literally don't sleep. I'll track it. I'll model it. I don't care who the president is, who the Congress is. We'll do it. That's how economic cycles have worked since the Peloponnesian War, before you and I and anybody in America was born, right? Here, we just go with the data. So I don't like to do speculative theory because to me, speculative theory doesn't have a good backdrop of working. You let the kind of real-time actions take its course.
I
And
appreciate
by the
that,
way, to my
Logan.
friends who I don't talk to anymore, who might be listening, because I know one of them is, you have no idea how glad I am not listening to yabble every single day. Big
Yes. Well.
babies. You're all a bunch of big babies out here.
Oh, okay. Well, maybe you're not. Maybe you're not giving a talk on friendship today. You're sticking to the
Oh
economics
no, no,
part.
no! If you want a friendship, get a dog, get a cat. Don't look at me. I'm here to destroy as many American bears as I possibly can while I'm alive. And when I die, I just want people to remember me for that. But I'm not here to be friends.
Says you. Okay. Well, Logan, thank you so much. We will have you on again later this week. Thanks for walking us through that, and have a great day.
Pleasure, Sarah.